as 16,000 more millionaires and entrepreneurs and billionaires are expected to leave the UK this year, 500,000 or 500,000 more people will be dragged into higher rates of tax, paying tax at 40%, which also means that more landlords holding properties in their own name are going to be affected by the Section 24 tax hike imposed on them by the last government, by George Osborne. So let's run through some of the figures. A lot of this is because of what's called fiscal drag, where they have not increased the threshold since 2021. So as incomes rise, more people are going to be dragged into the next band of tax. So this is quite serious. So as I said, 500,000 more people will be dragged into this, and that's going to affect landlords. I get a lot of emails from landlords saying that they are now subsidising their mortgages because they can no longer offset the interest against their profits, so it's eaten into their incomes, and because they're higher rate taxpayers, they're now paying more tax. And this is exactly what this tax was designed to do, and neither the last government or this current government seem to have any intention of repealing this, because landlords are seen as fair game. So looking back just a few years ago, 21 to 22, only 4 million people paid higher rates of tax, and it was considered, if you had a good job or you were a doctor or something like that, you paid higher rates of tax. But now ordinary people, teachers, and these are getting dragged into these higher rates. So now, this year, it's expected that 7 million people will be paying higher rates of tax. Just to give you a few figures here, just over 39 million people are taxpayers in the UK, and 7 million of those are higher rate taxpayers, or will be higher rate taxpayers, and just over 30.4 million will be paying tax at the basic rate. The annual threshold before you start paying tax is £12,570. So after that you start paying tax, and it's 20%, and it eventually goes up to 40%, and for the higher rates of taxpayers it's 45%. So as you can see, 40 million people, 39 million people roughly, nearly 10%, nearly 25% of those are going to be higher rate taxpayers. The state pension at the moment now has been going up, so that's £11,973, and 8.7 million people are now pensioners. They're drawing the state pension. So you can see out of 39 million taxpayers, getting on for 10 million of people are retired. So it's only 1 in 4. 1 in 4 people are retired. So the rest of the taxpayers have to support those pensioners who are claiming state pension, and this is what it was never it was never designed in this way. The state pension was designed with the fact in mind that most people wouldn't live that long in pensionable age, and there would be more like 5-to-1 ratio of people working against people drawing pensions. But that's not where it stops, because you've got a lot of people now on welfare and benefits as well. In fact, I want to go into a little information about how your tax is actually spent in terms of percentages. Welfare, which includes a lot of different things, but a lot of it is benefits as well. People on sickness benefits, disabilities, they're arguing about this at the moment in the government, and all sorts of other welfare benefits, accounts for 21.6% of the total tax take. Health accounts for over 20%, so that's 40% there just on welfare and health. State pensions now is actually up in the last couple of years. It was 10%, now it's 11.4%. So that's just in a couple of years. The state pension tax percentage of the percentage of tax paid just on state pensions has gone up to 11.4%, and this is why the governments in the West are alarmed, because they're starting to push it back, and they're talking about maybe reducing the rate at which these pensions rise every year. So between those three, welfare, health and state pensions, that's 50% of the tax we pay are just going on those areas. So the rest of us have to work to pay those things. Believe it or not, also, the national debt, the interest we pay on the national debt is now, well, it's just under what we pay in pension for pensioners. It's 11.1% of the tax take just on the national debt. It's double what we spend on defence, and it's more than we spend on education. So this is because the country's built up this, I think something like 3 trillion of debt that they're paying back, and the interest is we're all paying it. It's all coming out of our pockets really, and this is why the government have already increased taxes. This is why they're expected to increase taxes in the next budget, and this is why so many millionaires, entrepreneurs, billionaires, the Hinduja brothers have left as well. They were, I think, in the Sunday Times, they were the richest people in the UK. Lakshmi Patel, another one who was the richest in the UK, depending on which year you're talking about, he's gone as well, because they don't want to pay tax as non-doms. Now, that's the billionaire brigade. I mean, that's one category of people that don't want to pay tax on their worldwide income. They want to be treated as non-doms, non-domiciliary in this country for tax purposes. That means that if Patel has income in India from his factories in India, he doesn't have to pay tax in the UK on that because he's paying tax on it in India, which I think is personally I think that's fair. But billionaires bring a lot of money into the country, and he owned one of the most expensive houses in the country. I think his house in Kensington in Palace Green is worth about 57 million, call it 60 million, round it up, pounds. I mean, I don't know how many staff he employed. He also owned steel businesses in this country. He's paid hundreds of millions of pounds in taxes, in terms of corporate taxes and other things. And that doesn't include the VAT on the goods and stuff and services they buy in the UK. So a lot of people will say good riddance to the billionaires, let them bugger off, they should pay their fair share of tax. Well, what is a fair share of tax? He pays tax on his businesses in the UK, that's the fair share. But is it fair to tax him again on businesses overseas or income overseas? And you can say good riddance to these people, but it's the country that will lose, because they will lose the contribution that they make, and it's the top percentage of people that pay the most tax in the UK. So that's not good news. But other than that, it's what worries me more is the younger entrepreneurs who are leaving the country to go and set up in, whether it's Dubai or Portugal or whatever, into lower tax environments. Even Ireland, you can pay lower corporation tax in Ireland. When I get when you see Google, if you get a payment from Google, it's Google Ireland. I think Apple is probably also based in Ireland or one of the other European countries with lower taxes. A lot of the tech companies are not based here. Was it Starbucks, Luxembourg or whatever? Because our taxes are double the rate of Ireland in terms of corporation tax. So it worries me that a lot of the smart people, the young entrepreneurs, are moving away and setting up abroad. I mean, because if you're here and you're a multimillionaire and you've got family and grandchildren and that sort of thing, it's very difficult to just uproot and go. They would probably rather suffer the tax and stay. But for younger people that maybe are a bit more mobile, they are certainly leaving in droves, and that's not good for the country. We're losing good people, and every day people are coming across the water illegally, which are they're not contributing to the country. They're draining the country with the benefits and the cost of keeping those people. So that's a big mismatch there. So getting back to Section 24, this was a tax imposed by George Osborne, who's not a socialist. He's supposed to be a conservative. He imposed that a few years ago and said he's basically disallowing the interest payment that somebody holding a property in their own name would pay to a lender. The interest usually is offset against the income in order to reduce their gross income and bring out a lower net income on which they pay tax. And that's the same for any business. If you have a business loan and your business loan is costing you $10,000 a year and you've made $20,000 in profits, the business loan would offset that, and then your taxable income would reduce down to £10,000. But they've discriminated against landlords holding properties in their own name by disallowing that. Now, if you're a basic rate taxpayer, you get back a tax credit, which effectively gives you the interest offset. But once you go into higher rates of tax, you don't get that. So that's been affecting people, and I think it's grossly unfair. But it doesn't affect companies or people who hold their properties within a company, within a limited company structure. Now, when this tax was brought in, it really benefited larger landlords that already held properties in companies, bigger corporations and companies. So he didn't want to upset his friends in that way. So since then, I think now the de facto method of buying a property would be within a limited company. But back in those days, it wasn't that easy. Most lenders, buy-to-let lenders, wouldn't lend to a limited company. Oh no, limited company. Oh no, we can't do that. That's too difficult. It's not really that difficult. It's just you're still lending to the person. This person is still putting their neck on the line for the loan. They're still signing the guarantee. But now more and more companies have started to do limited companies. There's still some lenders that won't do loans for limited companies. It beggars belief, really. So what's happening now is that more and more people are buying properties within limited companies, and this means that the people with properties in their own name are either stuck paying higher tax, or they decide to sell the property, or they try and move the property over into a limited company, which then forces a sale. It forces tax, capital gains tax, and stamp duty as well. But there is a way around it, and that's why I've been recommending and using a firm of accountants that give free consultation on people that might be considering moving their properties from their own name into a limited company. Now, the general consensus is if you've got one property, it might not be worth it. If you've just got one buy-to-let, by the time you pay all the fees and that sort of thing, maybe it's not worth it. But if you've got 2, 3, 4, 5, 6 or more properties in your own name, and you're into higher rates of tax, and you're getting into higher rates of tax, it might be worth talking to this firm. So drop me a line at charles@charleskelly.net, and I'll put you in touch with them. There are other reasons for having properties in limited companies. It can help with just keeping those properties in one entity if you're building up a portfolio. It can also help with succession, passing that legacy on to your children or grandchildren, because you can give shares in the company and divide the company up easier than you can, say, dividing up 3 or 4 different properties to 3 or 4 different people. That can be a bit messy. So if you need advice on that, charles@charleskelly.net. And we're ending the week this week where the world has settled down a bit. There's a truce at the moment between Iran and Israel. So hopefully the world is calming down. Oil prices have dropped. They had rocketed at over $70 a barrel. They've come back down now by 10 or 15% already. Gold had shot up. It's kind of calmed down a bit now. But the stock markets just seem to carry on as normal, even during the war period, as if nothing was happening. And there is a fear that with the S&P 500 just almost at the all-time high, that we could be due for a stock market correction. But who knows? At the moment, there seems to be so much money piling into the stock market. Who knows how long this record bull run of something like 15 years will go on. We shall have to see. But I would be very cautious about having all your money in the stock market at the moment. So thanks very much for listening. If you need any advice on Section 24, charles@charleskelly.net, and I'll pass you directly on to the firm. They can give you a free consultation and tell you whether it's worth doing something about that, and hopefully save you some tax. Thanks very much for listening. Bye for now. This is Charles Kelly, Money Tips.